Hello, everyone, and welcome to this special edition of Your Business Incorporated. I am Bosin Amafaye here in Lagos. Ethiopian Airlines has been named the African Champion of the Year at the Africa CEO Forum 2019. Ivory Coast is getting ready to give out new licensing rounds on oil, but the job cuts in South Africa is continuing. About 2,000 miners may be out of jobs. Those are some of the stories across Africa and the world of business these days. But let's start with the story about Ethiopian Airlines, currently troubled by the recent Boeing 737 MAX disaster, has been named the African Champion of the Year. That's the Africa CEO Forum currently holding in Kigali. The award was held Monday night. This worthy recognition for the frontline African airline also rubs off positively on the airline CEO, Tewolde Gebramariam, who was also named the African CEO of the Year. Other winners are NG Africa, named the International Company of the Year, as well as two Nigerian companies. Access Bank of Nigeria was awarded Gender Leader, while logistics company, of course, also in Nigeria, named Kobo 360, was awarded the Disruptor of the Year. At least 90 miners in South Africa are at risk of losing their jobs within the next 3 years. And this is on the back of above-inflation electricity price hikes by Eskom, which has added to the already soaring operating costs. According to energy regulator NERSA, 71% of all gold mines and 65% of platinum mines were loss-making or marginal by the end of 2018. And the power price increases could worsen the situation. Total says it's made its first ever discovery of oil in South Africa. The find, with an estimated 1 billion barrels of oil in reserves, is located in deep waters around 175 kilometers from South Africa's coastline. The landmark discovery in a country with no crude reserves of its own could be a major boost for South Africa's struggling economy and enough to supply the refineries there for almost 4 years. Back here in West Africa, Ivory Coast is planning to diversify its economy by increasing local participation in the oil industry. So the cocoa country is currently in talks with French and Italian majors over the conclusion of licensing for 6 oil blocks by June this year to increase crude output. And though the government is currently focused on diversification agenda, Ivory Coast confirms there are no plans to make major changes to the oil sector code. Ivory Coast has 48 demarcated oil blocks, 4 of which are in production, another 24 under exploration, with output averages nearly 70,000 barrels per day. The Ivorian economy has so far been largely dominated by exports of the chocolate ingredients called cocoa and gold. So let's get on with the big story around Nigeria's MPC decision day. The Central Bank of Nigeria is expected within the hour to make some announcements regarding the end of the 2-day meeting by the Monetary Policy Committee meeting. So let's get this on. As always, our panel of analysts here to do justice to the discussions. Of course, we'll do a look back, then a look forward. Welcome my panelists this Tuesday. Let's chat with Johnson Chukwu, who is the CEO at Carry Asset Management. Thank you very much, Johnson, for coming my immediate left. And of course, sitting in the middle of the team is Ayodeji Ebo, who is the CEO at Afrinvest Securities. Ayodeji, thank you very much for coming.
Thanks.
And of course, the third panelist is Bite Oduneye, who is the CEO also at Eagle Global Markets. Bite, thank you very much.
Thank you for
We appreciate all of you coming here on the program. Of course, a panel of CEOs here to discuss this second Monetary Policy Committee meeting in the current year. But of course, this is very important because it's the first post-election MPC meeting and those decisions. Gentlemen, let's get this conversation going and look at where we are or where we're coming from since the nearly 3 months into the new year. And let me start with you, Johnson, in terms of, if you look at the January 20 meeting and the review, the central bank sounded very hawkish, and it looks like that hasn't changed.
Well, I don't think anything has changed in terms of the economic parameters. If you look at some of the major variables that they took into consideration in January, we are still available today. Look at the issue of inflation. Yes, inflation has moderated. I mean, in January, we're talking of an uptick in inflation. We've seen a moderation in inflation to 11.31%. But beyond that, we are still witnessing a sluggish economic growth rate, which will make it difficult for the monetary policy authorities to consider any rate increase. We also seen that the downside risk of further increase or a reversal of the decline you're seeing in inflation? Because if you look at the fact that the government, the National Assembly has just approved the 30,000 minimum wage and it has been sent to the president for assent, should that come into be implemented immediately, you're likely going to see some inflationary pressure coming from additional injection of liquidity into the economy. So that will certainly compel the monetary authorities to consider what measures to put in place to avoid any reversal of the current decline we need inflation.
So you think the background hasn't really changed? Ayodiji, do you think the background to this meeting, March 25 and 26, has any changed in any way?
I think in terms of the political
Despite
space,
the elections?
The political space, you know, then there was concern in terms of election, and that was also a major consideration then. But now we've seen the election has almost been concluded, and in terms of the confidence that we've seen in terms of inflows to, especially to money market instruments, has been very significant. And you look at it within a month between February and March, and the reserves have improved by over close to $1 billion, which is also significant. Well, because in the past we're talking about how to even manage the reserve. Currently it's around $43 billion. So, but when you look at in terms of the growth, CBN will be cutting between, balancing between stable exchange rates, growth rate, and inflation. So some of all these factors, there's been no major changes that we've seen to in all these major factors that have been mentioned. And we feel that the concern would be to see how the growth can be sustained, especially in the non-oil sector, which we saw in the last GDP report published by the National Bureau of Statistics. We saw the non-oil sector pushed growth higher to about 2.3% for Q4. So we'll see how the CBN or the MPC will be looking at how they can support in terms of the government, in terms of strategic sectors that can help jumpstart growth within the economy.
You look at the markets in the first quarter, it wasn't really so nice, January to date, as it were. The markets keep struggling, looking for direction, as it were, not sure where to go, despite very heavy inflow, according to stock exchange report, if we look at equities, that is.
I think the two gentlemen have stated it very, very, very well. We've gone through some headwinds, meaning that we've had a successful elections, which is always good. We have the price of oil staying above $60, a dovish Federal Reserve. I mean, looking at the global, the global economy, we've had significant inflows, as Ayodeji mentioned. I think it's $1.2 billion. But still, I suppose it's still a wait and see. I don't think we're much different from where we were at the last meeting. And the reason for that is not much has happened apart from the fact that we've had a successful election. So within the time frame, I'm not expecting any significant change from the central bank.
Monetary policy is a major driver, it's a major headline news everywhere in the world. Last week, isn't it? The US Fed and the Bank of England decided to leave interest rates unchanged. And everyone's concerned about what happens to the yield curve at the fixed income space, IODG. So how important is our own MPC here when meetings and announcements are made?
Yes, but if you notice what has happened in terms of the fixed income space in the last 2 months, yield was as high as 17% as of January, and CBN has been able to bring that down to around 14, 13% levels. I feel CBN have discovered, or the MPC might have discovered, that it's more effective to use OMO to guide rate downwards than just tweaking the MPR, because bringing down the MPR or a drop in MPR will not necessarily translate into improved lending. There are a lot of other factors that may be considered, because I know there are a lot of argument that for lending rate to come down, MPR needs to come down. That will not necessarily translate into improved lending, because the structural issues needs to be taken care of to reduce to the risks the real sector before lending can follow. So, but in terms of looking at the fixed income space, rates has moderated significantly, though it's stabilized around the 13% levels currently. So when you also compare it to the inflation rate, so in terms of positive reason, it's just about 2%. So with the significant inflow that we've enjoyed in the fixed income market, especially from foreign portfolio investors. We feel that for the MPC, the major concern will be how they can support the federal government in terms of driving growth within the real sector.
Johnson, do you think there's a disconnect here between fiscal and monetary policy, interest rates, policy rate, and what happens at the fiscal space? Of course, we've seen how interest rate and how to manage it by the central bank in terms of liquidity management, PMI, open market operations, and what have you, can bend the yield curve, as it were. But when it comes to translating it into the bigger, broader economy, how does it work here?
I think the challenge we have with alignment of the fiscal policy and monetary policy is basically because we've seen situations where the governments are unable to generate as much revenue as is budgeted. In the past 2 years, we've seen projected revenue less than 50% of budgeted revenue. And for that reason, we've seen situations where beyond borrowing from the bond market and money market, the federal government is also borrowing from the central bank. And that's injecting a lot of liquidity into the system, that the central bank has continuously mop up liquidity that is injected into the economy by way of lending to the federal government. So the actions of the federal government are not in tandem. I mean, the fiscal policies are not in tandem or in sync with the monetary policies. Because while the monetary policies have been focused on maintaining tight monetary position or liquidity position, the fiscal policies, because of the huge gap between projected revenue and government expenditure, is compelling the monetary authority to inject liquidity through the fiscal window. And that has created what we call liquidity overhang. Because if you look at the inflationary pressure we have dealt with over these years, was not triggered by increased improvement in consumption, was not triggered by expansion of credit to the private sector, but rather credit going to the public sector, to the federal government, through ways and means funding. So that has to be balanced as we go into the new fiscal year.
And you think we've tried to fund the fiscal space using the fixed income market because it used to be attractive to foreign investors, but it looks like we're the one piloting, we're the one having the stick end, and while foreign investors seem to have the carrots.
But it just doesn't seem to be sustainable. It doesn't seem to
How
be,
long do you think we can continue on this? We
model
are piling up rates,
yeah,
right?
Yes,
so they are piling up.
And in addition to that, of course, that would have some sort of effect on our equity market. Because if I'm getting those sort of returns in fixed income, there's no incentive for me to take part in the equity market. I think also a lot of these things are, I think it's mainly structural rather than monetary, the issues we have. You know, the poor infrastructure, the insecurity that is going on within the nation. There are a number of things, not just monetary, and I don't think it's something that can be solved predominantly with monetary policy. I think we've got to be a bit creative now with regards to going forward what the central bank does have in mind to stimulate the economy. But a number of structural issues is what is tying their hands, for me to put it in another way. There's only so much they can do because the infrastructure and the insecurity within the country is causing a serious problem. So there's only so much the central bank can use monetary policy to solve at the moment.
Can do, yeah. Okay, gentlemen, stand by. We need to take a break. When we come back, we'll look at the global headwinds for the MPC today. But again, also important, the central bank governor hinted last Thursday that the tight monetary policy environment will continue. For how long will this be? We're 2 years and counting. Let's take all of that on board when we come back after the break. A special edition of Your Business Incorporated, live here on Channels Television. We'll be back in 2 minutes.